Hi friends, welcome to my YouTube channel. In this video, we will be explaining bank guarantee concepts. So what a bank guarantee is? A bank guarantee is a mechanism using which a bank provides an assurance or a promise to the seller that the bank will make the payment to the seller in case buyer fails to meet its contractual obligations. It acts as a risk management tool for the seller as bank is assuming the responsibility to fulfill the contractual obligations in case the buyer is unable to fulfill the same. In this video, we will be explaining what the business problem is with an example, what the solution to that business problem is, various types of bank guarantees, and how a bank guarantee document looks like. So I suggest please see this video in its entirety to get a good understanding about bank guarantees. So what is the business problem we are trying to solve? So let's say there's a buyer and there's a seller. Now let's say the business case is that buyer wants to purchase equipment worth, let's say, USD 1 million from the seller. But having said that, the buyer doesn't have sufficient funds or sufficient money to purchase the good. Now they may get the money after a few months time, but as of now they don't have sufficient funds. So now the buyer needs the money on credit. So hence this is one problem. Second is there is no trust between buyer and seller. So how seller trusts the buyer, how the two parties trust each other. So that is the problem here, and that is where bank guarantee comes into the picture. So to solve this problem, a bank comes into the picture. Buyer will request bank guarantee of USD $1 million from the bank. Now here buyer can be a corporation, SME, or a contractor. Bank will issue the bank guarantee to the seller. Upon receiving the bank guarantee, seller will issue or release the goods to the buyer, and upon receiving the goods, buyer will make the payment to the seller. A point which needs to be noted here is the transaction is still happening between the buyer and the seller. Buyer is paying the seller. Bank is not paying the money to the seller upfront. Bank will only pay if in case buyer is not able to pay the money on the due date. So there are certain important aspects of this bank guarantee which needs to be noted. It's a promise which the bank or the financial institution is making to the seller that bank will pay the money to the seller in case buyer fails to meet his obligations. So hence it's a non-funded product, and it's like a contingent product whereby it is happening or bank will pay the money in case the buyer defaults. Bank provides the bank guarantee for some collateral. So buyer has to give some kind of collateral, financial collateral, like any sort of deposit or some kind of security, or let's say a mutual fund, to the bank. it's bound by a validity period. So when buyer says that they will make the payment, it has to be upon a due date or a validity period. It's an absolute or a specific amount based contract where it says that the bank guarantee is given for so and so amount. The buyer or sellers, as I explained, can be corporations, contractor, or SMEs, and the bank takes fees from the buyer for giving the bank guarantees. There can be various types of bank guarantees, which I'll explain in the next slide. Now, how the bank guarantee helps? Bank guarantee helps in increasing the business because even if the buyer doesn't have the money from day one, they can get the guarantee and facilitate the trade on the basis of the guarantee. And also, it's act as a tool to build trust between the buyer and the seller. So it's a win-win situation for both the parties. Now let's see the next slide for seeing various types of bank guarantees. So now let's discuss various types of bank guarantees. There are two broad categories of bank guarantees. A, trade related bank guarantees. B, contract related bank guarantees. Now, trade related guarantees we just now discussed in the example are those which are to cover a trade or buying and selling of goods between two parties, buyer and seller. And contract related guarantees are those guarantees to cover the contracts, like for example when a government issues the contract for big projects like rail projects, road projects, etc., or big corporation issues projects. So those are contractual related guarantees, and we'll discuss them in detail with example in the next slide. In this one, let's cover the trade related guarantees. Trade related guarantees are of three types. One is the payment guarantee or the financial guarantee, which we just now discussed, whereby bank, buyer, and seller are involved, and banks give assurance to the seller for fulfilling the commitment in case buyer defaults, and in lieu, bank charges a fees from the buyer. So this is a standard example of a payment guarantee, and buyer commits to make the payment upon the delivery of the goods. In this payment, another variation is a deferred payment guarantee, whereby in case, let's say, buyer doesn't have money upon the delivery of the goods, so buyer makes an arrangement with the seller that I will make the payment to you after a deferral period, let's say 6 months. So from 6 months, upon the delivery of the goods, buyer will commit to make the payment, and in this case seller may charge 6 month interest from the buyer to cover its risk. So this is another form of payment guarantee where the payment is deferred for a deferral period by the buyer. Now there can also be another form of trade related guarantee to facilitate exports and imports, which is called foreign bank guarantee, whereby buyer and seller are from different countries, say India and US. So here the borders are different, and here the concept of correspondent banks, which is can be a domicile bank for the seller, can also come into the picture. So these are the forms of trade related guarantee. Now please see the next slide for contract related guarantees. So now let's discuss bid bond bank guarantee. It's a form of contract related bank guarantee. Now let's say there's a government agency who needs to start a project, let's say a rail project, whose estimated project value is, let's say, USD 1 million. Now, to start this project, the agency invites bidders. So there are various companies, let's say company A, B, and C placed or bid for this project. The agency, the government agency here in this example, asks each and every company to provide bid bond bank guarantee of USD 10,000 each. So as you can see in this diagram, each company A, B, and C, who are the bidders, has provided the bank guarantee of USD 10,000 each. Now, why this is required? This is required because, let's say, the government agency who spends some money as part of the bidding process needs to mitigate its risk. The risk here is, let's say, a selected bidder, let's say company B is selected and company B backs away from the project. So if that happens, the agency will ask USD 10,000 from the bank as part of this bid bond bank guarantee to cover its risk of the cost which is spent as part of the bidding process. Now let's see some important aspects of this form of bank guarantee. As we discussed, it's a contract related bank guarantee. It's basically protect the government agency in case successful bidder backs out from the project. And this is a time when this type of guarantee gets invoked. Bid bonds are generally 1 or 2% of the estimated cost of the project, but it can vary depending upon the contract. And the bank here provides a guarantee on behalf of the bidders. So it's basically protects the government agency and mitigates the risk of the cost which is spent during the bidding process. This is also known as earnest money deposits. Now let's understand advance payment bank guarantee. Let's understand this from the same example which we use for bid bonds. So let's say there's a government agency who starts a rail project of USD 1 million. Company B is the bidder who successfully gets this project. Now there's a situation whereby company B says that I don't have money to start the project. So can you please give me advance payment of USD 100K? So the government agency gives the advance money to company B. However, the agency asks for advance payment bank guarantee of the same amount. This guarantee is basically to mitigate the risk of the government agency against the advance payment which it has given to company B. Because it might happen that company B runs away or is not able to deliver. So the money which has been given by the agency is protected and it can claim that money from the bank who has given the guarantee. Now these are the important aspects. It's again a contract related guarantee. It's basically given to the successful bidder who is into the contract with the company. It's given against the advance payment money which is being given by agency to the company, and it's invoked when in case the company B is unable to fulfill or fails to fulfill the contract. Generally, this is generally 10 to 15% of the contractual value, but it can vary. Performance bank guarantee. This is another form of contract related bank guarantee. So let's understand this with the same example. Let's say the government agency is doing the rail project of USD 1 million with the contractor company B. Now, as and when the project progresses, the government agency makes the payment on periodic basis to the company B. Depends upon how much completion etc. has happened of the project. However, there might be situations whereby company B is unable to deliver the project completely, or there are some incomplete items, or there is some non-performance on the part of the contractor. So, in those scenarios, or to mitigate this risk, the government agency asks for a performance bank guarantee worth, let's say, USD 100,000. So this guarantee is invoked in case of non-performance or some defects, depending upon the situation. So they are the important aspects of this guarantee. Again, it's a contract related guarantee, and it's to cover the agency or the government agency from the non-performance of the contractor. So friends, this is the sample bank guarantee format. Now, as per this document, DF company is a seller, ABC company is the buyer, and the bank here is providing the guarantee to DF company on behalf of ABC company for a certain guarantee amount. Now, this format can vary depending upon the type of guarantee, depending upon the region, depending upon the parties involved. This is an example of a simple financial payment guarantee, trade related guarantee, which we discussed earlier in this video. Thank you, friends, for attending this presentation. Uh, this is an honest attempt to explain bank guarantees and various concepts around it. If you like this presentation, then please click like, share it to further audience, and subscribe my YouTube channel. If you have any further questions, you can publish in the comments and I will respond. Thank you once again.